Hello and a warm welcome to Econoday Unplugged on Tuesday, the 10th of August 2021. Terry Sheehan is stateside and I'm Jeremy Hawkins in London. Well, July's surprisingly robust US employment report has ensured that the Jackson Hole's economic policy symposium later this month will be blinking brightly on investors' radars. Moreover, speculation about how and when central banks in general will switch from quantitative easing to quantitative tightening was given a significant boost last week by the Bank of England's report on how it plans to shrink its balance sheet once exit conditions have been met. Still, with COVID cases once again rising rapidly in the US, at record highs in several Asian countries, and in Europe, at best, only really flattening, the outlook for the global economy remains very uncertain. And for now, the risks, if anything, are probably still tilted to the downside. Inflation may be high, but central bank tightening in most parts of the world remains a long way off. Nonetheless, July looks to have been a good month for the US economic activity. So, Terry, was it, or did the employment data flatter to deceive?
The employment data was, in fact, surprisingly strong and in areas where we would like to see strength. I think a lot of Fed policymakers would still say at this point there's needs to be more progress in healing the labor market. But 2 months of near 1 million jobs added probably qualifies as what they call substantive further improvement.
So does that mean on what we've got the usual sort of raft of Fed speakers over the next couple of days or so?
Yes,
what kind of message do you think they'll be sending, and will they be singing from the same hymn sheet?
No, they will not be singing entirely the same tune. I looked over the FOMC voters this morning because, of course, they're the ones who will make the final decision in September. But it really looks like for where we have comments that have been after the employment report, they are leaning heavily towards starting the taper. Now, whether that's later this year or early next year, we don't know, and it varies from individual to individual. But it would seem that the balance has been tipped, and there is more consistency among the Fed policymakers about starting the taper probably this year.
Okay, so we don't have another FOMC meeting until, where are we? Latest September, if I remember rightly.
Yes.
So Jackson Hole and all that. You did touch on that, I think, in last week's podcast.
Yes.
But in light of the payroll, et cetera, has that become more important than ever to give investors an idea of what the Fed might be doing next?
Well, whether Powell considers it more important or not, it's hard to tell. But at this point, I think anticipation of a strong signal from the Fed and Powell in particular about the taper can be expected. And if the various economic data over the course of the month continues to look good, I think it's a topic he will have to address.
Right. Okay. Let me ask you, so it's a relatively quiet period for US data and indeed European data as far as this week's concerned, but we'll be getting an update on what University of Michigan sentiment numbers on Friday. Now, from what I've seen, they're still well short of the kind of highs we had, going into the COVID period, and certainly didn't seem to do anything towards stopping very strong household spending in the second quarter. So, do you think this will give us any kind of clue about how spending might go forwards, or is just the sentiment numbers now too decoupled from what's happening to actual consumption?
Well, of course, sentiment numbers tend to fluctuate a lot in the short term, especially when you see things like food prices and gas prices going up. So that tends to depress confidence. However, in the US, they began distributing checks for the child tax credit last month, and I think spending itself is going to go up, even if consumer confidence doesn't. The other thing is this morning we got the NFIB Small Business Optimism Index, and it was below expectations, but it also remained consistent with moderate economic activity. So the sense is, on my end, is that, although we're not seeing huge increases in confidence and we're not back to pre-pandemic levels, on the whole, confidence seems to be pretty decent. It's not fluctuating too much up and down at this point. And although there's a lot of uncertainty, especially related to the new variants of COVID, overall, I think there's a sense of an ability to get through this.
Okay, fair enough. And I guess, I mean, typically speaking, or at least over the last few months anyway, that the kickoff point for discussion would have been US inflation numbers. But suddenly markets don't seem to worry too much about inflation, or at least they seem very relaxed going into this week's CPI. So just with regards to that, what we'll get the July CPI your side tomorrow, isn't it? What's expected on that?
It's expected to continue to be well above the Fed's 2% target, but it is expected to be continuing to ease up. In other words, less inflation than there has been. It's actually interesting is what we're going to see after the CPI report tomorrow is the U.S. makes its cost of living adjustment for things like Social Security payments based on the third quarter inflation data from the CPI. And July is the first month of this. So we're actually going to get our first sense of whether retirees and such will be seeing rises in income early next year, which may actually contribute to a sense of confidence about the economy because people will probably be seeing larger increases than they have for quite some time.
Interesting. Actually, just before I let you go, on the sort of earnings side of things, in the UK, the Bank of England last week, when they were talking about prospects for inflation and everything else, UK side, they made a comment to the effect that wage growth in the UK, like in so many parts of the world at the moment, is being biased up by compositional effects caused by COVID and in some cases furlough programs and whatever. Now in the UK, regular earnings growth, so-called, is running just over 6% at the moment. But the bank came out and effectively said that underlying earnings, once you take out these various distortions, was only around about 3% or something like that. So pretty well where it was before the virus itself actually arrived. Are there any kind of estimates of what's happening to underlying wage growth on your side, which the Fed might be looking at closely?
I haven't specifically seen any. I know in the latest personal income data, it was pretty clear that wages and salaries are growing above their pre-COVID trends. This has a lot to do with the shortages of workers over here for a number of jobs. Although we still have millions unemployed due to COVID, our job opening rate is actually at a record high right now. So the competition to attract and retain workers is pretty fierce, and it is leading to wage growth that is somewhat above trend from the pandemic.
So that could still be a leading indicator then for what might, as to whether or not this inflation boost we've got at the moment is going to be transitory or last rather longer than that.
Yeah, we're not necessarily going to see those wage increases continue, especially if, as unemployment benefits run out and some of the emergency programs end next month, people are, in some sense, going to be forced back into jobs, and more workers mean less competition on the part of employers. So they probably won't have to offer quite the same level of increases in wages that they have, but they still have shortages of qualified workers for those jobs. So the workers with the right skill sets are going to have more negotiating power.
Yeah, it's going to be interesting. That's very true, I think, of parts of Europe, particularly in the UK as well, to see what happens on that front. Okay, brilliant. Thanks for that. Right, a bit from my side then. Was mentioned in the intro, as far as Europe's concerned, COVID cases at least starting to level off now and really have been, I guess, since the start of August. And also promising news, the fully vaccination rate, that's up at 51.5% of the population now for the European Union as a whole. Well, that's actually now above the US, which is running about 50% or so. There has been then a fairly sharp acceleration in the vaccine rollout going right across Europe. Germany in particular has benefited. So that's all positive for potential growth news. news, but France and France and Italy have both already introduced COVID passports. These will be necessary for the general public to have access to many venues. Germany is expected to go down the same route soon too. So that could still hit demand, particularly from the non-vaccinated sector. So again, there's still a lot of uncertainty exactly about how the European economy is going to shape up over the course of coming months and restrictions. Indeed, there's still a number of restrictions on cross-border travel within the Eurozone countries, with individual countries essentially doing their own thing, irrespective of the fact that we're supposed to have the free movement of people and capital right across the region. Terry was mentioned earlier that by and large sentiment in her part of the world seems to be holding up pretty well, where it does seem to be struggling a bit more in Europe now. Most of the surveys have suggested that both consumer and business confidence has at least come down somewhat over the course of the last month or so. And that again appears to reflect concerns about this Delta variant from COVID. Indeed, this morning we had the German ZEW survey, which is a pretty closely watched survey of what analysts are actually saying in Germany. That showed a fairly sharp decline in expectations, and they've been coming down the last 3 months or so now. So it does again suggest that by and large there's increasing caution about how the economy is going to perform as we go through to the end of this year, and of course much of it really due to the COVID situation. With regards to data, it's a pretty quiet this side of the pond too in terms of big numbers, but we should get some further evidence on Thursday of the weakness in the goods producing sector. Really, it is a case of the big two, France and Germany, struggling at the moment. Last week, we had the update for June industrial production in Germany. Despite what was supposed to be a pretty well booming sector, according to all these business surveys, industrial output fell again. It was down 1.3% on the month, and lumping it all together, that puts it down 0.5% in the second quarter versus the first quarter. In other words, the goods producing sector made a negative contribution to GDP growth, despite expectations, at least early forecast, it would make a fairly significant positive impact. Now, all this is despite the fact that if we go back to, the move since February of last year, so pre-COVID, industrial production now is down almost 7%, and yet new orders are up more than 11%, and backlogs, so those orders which haven't been filled yet, they're rising almost 14%. So as we've talked about before, it really does reflect the damages being caused to output from all these supply chain disruptions. What else we got then? Well, as far as the rest of the main European news is concerned, I guess the most interesting bits and pieces came out of the Bank of England last week. So no changes in terms of overall policy, be it quantitative easing or what's happening to interest rates. If anything, perhaps a little bit surprising, it was only one dissenter in favour of ending the quantitative easing programme early, despite all the speculation. That was Michael Saunders. But it's got to be said, had the chief economist who left in June still be there, Andy Haldane, and most likely it would have been at least two dissenters. And anyway, in any event, the bank was again forced to raise its inflation forecast even further above the 2% target mark. It's now looking for a peak rate of about 4% by the back end of this year. The forecasts are also more optimistic about the growth outlook, and at least some members do seem to think that the conditions for achieving the 2% inflation target sustainably have been pretty well reached now. Consequently, it's the thorny issue of how and when to tighten is now very much being discussed. And on that front, there were some significant changes made to the previous plans for the QT, the quantitative tightening process. So previously, as we touched on last week, there was supposed to be no reduction in the bank's balance sheet until bank rate had reached 1.5%. Currently, of course, it's just 0.1%. Now, that threshold has been slashed to just 0.5%, at which point the bank will stop reinvesting maturing assets. So essentially, just allowing the balance sheet to shrink as those assets roll off. That would effectively mean withdrawing liquidity of about 70 billion sterling or so in 2022 and 2023. Now, another 130 billion would be withdrawn in 2024 and 2025, just as things currently stand at the moment. Now, once the 1% bank rate has been marked, then that, in theory, would be the threshold, the real target level for quantitative tightening to be ramped up. and the bank then would actively begin to sell its assets. So this would be undertaken at a gradual and predictable pace, the bank's saying, so as not to upset financial markets. But the bottom line is it means now that quantitative tightening is likely to happen sooner, and I guess what, perhaps significantly sooner than seemed likely under the previous interest rate threshold. Now that's good news for the pound, and indeed sterling took last week's announcement by the bank pretty positively. Data front this week, really, it's just all on Thursday for the UK when we'll get our first look at second quarter GDP. That's expected to be up 4.8% quarter on quarter. So in US terms, season adjusted annualized rate, we're talking just short of 21%. So that's a solid recovery for the second quarter as far as the UK is concerned. Probably implies June GDP, the monthly number, an increase of about 0.9%. And most of this is going to reflect, by the look of it, a big bounce back in household spending on the back of looser COVID restrictions. However, and crucially for those people looking for an early hike in interest rates, even that would still leave the UK economy slightly more than 2% smaller than it was before the pandemic struck. So things going well in the UK, but in terms of outright tightening, there's still some way to go yet. Around off my side, we just quick look at Canada, the labour market report there last Friday. It was weaker than expected, but really put in context, a 94,000 increase in payrolls after an increase of some 231,000 in June constitutes a pretty decent pickup in economic activity. Indeed, total hours worked were up almost 1.5%. But again, the unemployment rate is still, about 1.8 percentage points above its pre-pandemic level. And the bank's going to want to see that gap narrow before really contemplating any increase in interest rates. But bottom line, reopening of the economy does seem to be going well. The fully vaccinated rate is up at a very high 62% now. That really has taken off extremely sharply in Canada over the course of the last month or so. And since we've got headline and core inflation both above target, there's every reason for supposing that the additional QE tapering markets have been talking about isn't that far away. Next Bank of Canada meeting is on September the 8th. And I guess that's pretty well it from me this week. So there's not a great deal going on. So Terry, do you have anything else you'd like to put into the pot?
No, I think you've got it about all. I think it's just going to be a quiet week overall.
Yeah, let us hope so. Summer holidays are supposed to be here after all. Okie dokie then, that is it for this week then. So on behalf of Terry and myself, thanks as ever for listening. We'll be back next week, and in the meantime, as I'm sure you know already, all the key market moving data and events can be found, listed and analysed in Econoday's comprehensive global economic calendar. We'll see you next time. Bye for now.